Testing, testing. Yes, it's working. Very good. I will start by saying that I'm not going to even claim to have more knowledge than Fadi. That was an excellent presentation. But good afternoon, everyone. Thank you very much for taking the time to watch my presentation. My name is Michael Barbour. I'm the Sales Director at Traders Hub. It would be remiss of me to use this opportunity not to let you know a little bit more about Traders Hub, who we are, and what we provide. So at Traders Hub, we are an Emirati brokerage based out of Abu Dhabi. We provide our clients with a pure STP experience. If my clicker is working. I am pressing very hard. Oh, there we go. There's me. Okay. So yes, we're based out of Abu Dhabi. We are pure STP with a global reach. We're actually overseen with a Category 1 Securities and Commodities Authority license as well. We offer our clients really competitive spreads, zero commission, swap-free accounts, and local support and expertise. Now, what we have noticed with our growing global client base is that they are actually using our platform to complement and enhance their more traditional investments. So what is a traditional investment account? Well, generally, you're looking at stocks and equities, commodities, bonds, cash, and real estate. What I will say is the analogy that I like to use is that a really strong investment portfolio is like a really well-built house, as you can see here. So how you need to look at it is a diversified portfolio is built up of different asset classes. So you've got your cash, you've got your stocks, you've got your commodities, your bonds, and a bit of real estate generally in there. So I like to view the cash as like your strong foundation. So you can really, it's not exposed to those external factors. And if anything is to go wrong, that cash is there really as a support mechanism for the unexpected to happen. Then you have your bricks and your mortar, which would be like your stock investments. They build your walls up, they give you that growth. And if you are looking to continue to grow, you can stick an extension on the back or build a pool in the back garden. But in order to do that sustainably, you need some buffer. And that's where your bond investments come in. They're like your mortar, they're like your insulation. They protect you against that outside exposure because your stocks are not without risk. They are facing the outside world, just like the walls of a house are facing that extreme weather. On top of that, you've got your real estate that acts as the roof. Again, that's protecting you from the external instances that can happen in the market. Less correlated with the rest of the asset classes, but still extremely important. And finally, you have your commodities. Your commodities are like your utilities, your gas, your electricity, your water. And what they do is they kind of protect your investments. So no matter how bad things are externally, your commodities are helping you internally. It's like sitting in front of a roaring fire with a hot chocolate while there's a big storm going on outside. So how does a traditional investment look? Well, generally you're talking about 50% in stocks and shares, 10% in bonds and cash. You're talking 5% in commodities and maybe 15% in real estate. So if we'll just get this to carry on. It's got a mind of its own, this presentation. It's a little bit out of sync, I think. But I'll carry on anyway. So, yes, a traditional investment portfolio kind of looks like 50 to 60% stocks. You're talking 10% in cash, 10% in bonds, 5% commodities, and maybe 15% in real estate. Now, you're probably thinking, okay, Michael, that's tried and tested. We all know that. That's a typical investment portfolio. So, where do CFDs fit into this strategy? Well, actually, CFDs are a really useful way to enhance the growth of those typical portfolios and also help you to mitigate risk. That's because CFDs can offer you some great diversification. Now, the diversity that CFDs offer are really coming down to the fact that it gives you a wide market access to different asset classes. So we're talking about indices, commodities, we're talking about Forex, and even nowadays crypto. And you can get into those markets at a lot smaller margin than you would in the traditional stock markets, commodity markets, and the bond markets. Now, secondly to that, because there is such a vast array of CFDs that are available, you can actually use the CFD market to diversify your investments. So you can maybe invest in correlated or uncorrelated CFDs to help enhance that diversification. Now, on top of that, we have things like enhanced returns. Obviously, we all know that the CFD market is leveraged. So with CFDs, you can make significant gains on a much smaller initial investment. So what I want to do next is I want to go through each asset class and talk about how CFDs can help you enhance the growth and also mitigate the risk involved with investing. So firstly, we'll start with stocks. Stocks, as we've seen, take up maybe 50 to 60% of most investment portfolios. So how can we use CFDs as a risk management tool or even to enhance the growth that we can get from our traditional stocks? Well, the traditional play here is to use the CFDs as a hedge play. So, for example, if you are holding Apple stock, but you think that potentially there are some bad financials going to come out, or maybe the launch of the latest iPhone hasn't been as promising as predicted, and you think the stock price is going to go down in the short term for Apple, but you don't want to minimize your exposure because you think in the medium to long term that's going to go back up. What you can do is take a short position in the CFD market on a CFD for Apple, and therefore you can mitigate the short-term losses with gains in the CFD market, a typical hedge play. Now, secondary to that, you can also use CFDs to make a double gain. So if you think maybe the launch of the iPhone went as expected, better than expected, and you're expecting to see that stock go up and up and up, but potentially you don't have the equity or the collateral to buy in the traditional market, you can take a long position in the Apple CFD for a lot smaller initial investment, and then you can gain on both the stock market and then also on your CFD position. Now, if we look to commodities in our diversified portfolio tend to be used to hedge against inflation. This is time and tested. Investors, when the markets get volatile, they will migrate their investments to safe havens like gold, and gold is absolutely flying at the moment. So what we can see with CFDs is a couple of ways to use strategies to enhance the positions that you hold with regards to commodities. So if you are a spot commodities trader, you can actually take a larger CFD position without the physical storage and the costs that are associated with that. Also, because CFDs are tagged to the price and not the underlying asset itself, what that means for you is that you can take advantage of the fluctuations in the commodities markets with a lot lower exposure. Now, if we move on to bonds, bonds are seen as the safest of safe investments. They're there to withstand the storm and the volatility that is the traditional equities and commodities markets. So you have the opportunity to trade things such as CFD bond indices, and this provides you with great diversification because you have the opportunity to hold not only short but also long positions. And if we move on to more to the Forex side, which is the cornerstone of most portfolios, the performance of your underlying currency can really decide the performance of your overall investment. Most people who trade CFDs are hedging the Forex market in order to protect themselves to fluctuations in currencies, especially their underlying currencies, and preventing significant losses there. When it comes to the real estate side of things, that's probably the least correlated of all. However, there are still some brokers which will offer you access to real estate indices, CFDs, which means that you can have access to the real estate market at a significantly reduced cost and without the complexities of ownership. So I think, as you can see, CFDs can not only be used to enhance, but also to mitigate risk going forward, be that through hedging your normal position, hedging your position that's held in an external market, be that through using the leverage nature of CFDs to amplify your gains. There are many different strategies that can be used to insert CFDs into a more traditional investment that you have. If you have any more questions for me, you can come and meet me or my team at booth number 68. And it's been great to have you all listen, and I hope you enjoyed the rest of the expo.